With a potential plan to save USDC, does that mean that crypto and Bitcoin is now safe? We have seen SVB, the Silicon Valley Bank, struggle immensely, and we've also seen Silvergate Bank as well, struggling immensely. We've seen bank runs across the US, and I think there's also going to be a fallout in many other countries around the world. And we've also seen some interesting things with the on-chain data that suggests there's also a crypto exchange run occurring as well. Are you on an exchange? Have you managed to get off the exchanges? And let me know in the comments down below. In this video, we're going to be jumping down into a lot of data, taking a look at a lot of different things that help us understand whether or not we should be bullish or bearish on Bitcoin. Now, as I get into this video, if you find it useful, informative, smash the like button. I do appreciate that. If you're new to the channel, then do subscribe to stay up to date with everything that we do here at Cheeky Crypto, and I don't think you'll be disappointed. Now, if you haven't joined us in Discord, you are missing a trick. This is the first place that we go to notify you of everything that is going on in the crypto space. It can be a little bit complicated to join, but we make it so that many of the scammers and bad actors in the space struggle to get in. So do persevere and join us in the Discord. I don't think you would regret it. Now, let's make a start with this. We're going to start off by taking a look at the on-chain data. Then we're going to come back and take a look at the charts and kind of try to put things together and piece the puzzle so that we can understand what's going on. Now, as I said earlier, we have USDC depegging. It's starting to stabilize a little bit. And we also see that there's a plan to a proposal, I should say, to kind of plug the hole with the exposure to Silicon Valley Bank when it comes to $3.3 billion of the funds. Now, that is only $3.3 billion of the 40 billion of reserves, and we have to bear in mind that not all 3.3 billion would be at risk from Silicon Valley Bank either. So there's a lot of things to kind of think about when it comes to USDC. That being said, it is what it is, and we can kind of deal with it. We've seen this a dozen times already. It's slightly different scenarios, yes, but this stuff doesn't scare me in the slightest. Now, there's a lot of things that we should be quite fearful of, but as long as we are reading the data and understanding the possibilities of what could unfold, that puts us in a rather strong position. It means there's opportunities that are afoot and we can take advantage of them. And that's why we're going to be taking a look at this on-chain data today. Okay, so up here in the top right-hand corner, we have the inflows, the outflows, and the difference between the two. And all of these numbers are from the 1st of January 2023 to yesterday. Okay, that would have been the 11th of March. Now, we can see here that we had 1.9656 million Bitcoin going onto the exchanges and 1.9820 million coming off the exchanges. This means that 16,390 Bitcoin has come away from the exchanges, and this is interesting. It's interesting because this number was positive only a few days ago. This means that there is a bit of a run occurring on exchanges. First come, first serve. Are you on an exchange? I want to urge people that if you've got crypto on exchanges, that you kind of consider your positions. Now, I'm not a financial advisor. I cannot give you financial advice. What I would say is you're holding an additional risk by holding your crypto on an exchange. Linked in the description down below, there is a link to Ledger. Ledger is a cold wallet, hardware wallet, that essentially keeps your crypto private keys off-chain. Off the internet, right? And essentially what this means is that your funds are self-custody. You're able to look after your own cryptocurrency. It's a little bit of a learning curve if you're new to it, but essentially I think it's very, very much worth it. It's a way to kind of add a level of protection. So not only are you holding a cryptocurrency, which is a risk-on asset, you're also holding that risk-on asset on a risky platform. So you want to kind of limit your risks where possible. So check it out, linked in the description below to Ledger. There are many other brands out there. We like Ledger. We're affiliated with Ledger. I use Ledger devices all the time. We're very familiar with them, so if you ever have any troubleshooting, you can join us in the Discord and ask us the questions of how to do this X, Y, and Z, for example, and we'll be able to help you. When it comes to other hardware wallets, we're not as familiar with them. We might not be able to assist as much. But anyway, nonetheless, do your own research. The only thing I would say when it comes to hardware wallets is to make sure that you buy it directly from the manufacturer. Do not buy it from a third-party website. There are a lot of fakes out there that have firmware changes that basically leak your private keys to hackers and so forth. So always buy it directly from the manufacturer. Okay, so if you're on an exchange, priority number one, in my opinion, right now is get off of the exchanges. You do not know what exchanges have exposure, okay, because they're not necessarily being overly clear with us, exposure to either Silvergate Bank or Silicon Valley Bank. Okay, so make sure that you're doing yourself justice and you're looking at the risks correctly. Okay, so if there's a bit of a run occurring here, it's only just starting. These numbers are small, okay, but they're numbers that are increasing over time. So we want to be a little bit cautious here. Okay, so we can see here that this is what was happening on this line graph during FTX. This is the level of withdrawals from the exchanges. This is where we are right now. Okay, so if we're going to see something very similar, then we need to be aware that it's only just beginning and we want to get ahead of that curve where possible. Okay, so inflows have increased, but so have outflows. Outflows are outpacing the inflows, which is also interesting. So let's go ahead and jump onto the next area, right? So here we can see a line graph of the inflows and the outflows. Now the inflows are down here yesterday at 65,000, and we saw inflows were 54,000, outflows were 65,000. Now, why is this alarming to me? This is alarming to me because yesterday was a Saturday. Now, what happens over weekends normally is a decreasing activity. Okay, we normally see the inflows and the outflows drop over the weekend. Saturday and Sundays are low. You can see this consistently every single 7 days. There is a massive dip with the inflows and the outflows. Yet here we can see the spike to the upside. This means that there is a huge run about to occur, in my humble opinion, on exchanges. Not only are we only just starting to see this, smart money is coming out, but we can see that this is an unusual activity that wouldn't normally happen over the weekends. The second that the week starts, I think this is going to really compound, and we're going to start seeing a lot more institutional players withdrawing. And once that happens, it's going to be more obvious, and there's going to be mass panic as people try to rush to the exchanges to withdraw their assets. It's like I said, make sure you're not on an exchange. In my opinion, it's a risk that you don't need to necessarily hold. Now, let's move on as we take a look at the wallet counts. Now, the wallet counts are an indication as to not only people withdrawing from exchanges, but also buying and selling, as in some people are selling, some people are buying, and so forth, right? And it's important that we kind of reflect on who is doing what, i.e. is big money, smart money buying, or is big money, smart money selling? And is it actually only dumb money that's left holding the positions? So here we can see that Bitcoin Dust represents a wallet that has over 0.01 Bitcoin. This is the most vulnerable retail investor. Now here we can see that there's a significant surge to the upside. They're buying the dip. They are being told that we're in a bull market and that essentially you can buy the dip because, we're in a bull market. There's nothing possibly that can go wrong here. Okay, this obviously is not necessarily factually true. Not only is a bull market a definition of when the demand outpaces the supply, which we do not see, it also has much higher, significant more, in fact, volume through it, which we are not seeing. We're about 1.5 million in volume short of what the previous bull market started at. So we know that the volumes are low, and we also know that we don't have the data that supports the very definition of a bull market. Not only that, we also know from the charts that we don't have the structure to support a bull market either. So this is very unfortunate because they're buying a dip, which I don't think is a wise idea. Now, they can, of course, come out. They got shaken out before. 100,000 wallets dropped off over here, and then have accumulated back up again. There are 11,646,662 wallets that have over 0.01 Bitcoin in them. So really interesting stuff. Now, as we come up into the other retail-sized wallets, there's 3 of these. We have Krill, which is over 0.1 Bitcoin. We have Shrimps over 1 Bitcoin, and we have Dolphins over 10 Bitcoin. All of these are going up. Now, this is either one of 2 things. One, they were now withdrawing from the exchanges, so you see an increase in the wallets, or they are buying the dip because they believe that they're in a bull market, okay? Those are the 2 options that are really available here. All of the retail investors are acting the same way, emotionally, and that's why they are tagged together as retail investors. We also kind of use the term, I don't like it, but dumb money. I mean, I'm a retail investor, I'm not an institutional investor, so I don't like the term dumb money, but essentially that's usually what is defined as retail investors. Whereas smart money, which would be these 3, are basically institutional funds, big funds, right? So we can see here sharks over 100 Bitcoin. They actually did buy up the little bit of a dip just here recently, which isn't too bad for people who I believe to be traders. Okay, so I tag these as institutional, but these are basically professional traders. They bought up Bitcoin before the pump, right? They bought it down at the lows of around like $16,000, and they've ridden it all the way up and taken profits. So when they start seeing an uptake here, they are either misreading the data or they're onto something. I think that they're about to finish a fifth wave down lower, so accumulating down here actually isn't terribly too bad from a trading point of view, in my opinion, because I do expect a move upwards at some point soon. Now, when it comes to bigger institutional wallet sizes, though, we do have problems. Now, here we can see Bitcoin whales over 1,000 Bitcoin per wallet has significantly dropped. So we were looking at this thinking whales were buying. We might finally see that selling from the retail side to the institutional side, and we haven't. In fact, they've just done a U-turn, and well, they're coming back out. We're now at 2003 wallets, and so continuation of the selling pressure. They're not buying the dip, and that tells us everything that we need to know. We can also see that the Kraken size wallet has also taken a bit of a dive from 118 wallets down to where it sits right now at 116 wallets. This is over 10,000 Bitcoin per wallet. So they've dropped 2 wallets, which basically means 2 wallets have now dropped down lower than 10,000 Bitcoin. So from the higher levels, we can see that there's a lot of selling pressure. And therefore, if there's selling pressure at the higher levels, then it's the lower levels that are buying. So there's a mixture here. Like I said, we can see a lot of outflows occurring, and I think it's a lot of it is being driven from this retail side, whereas the inflows up here, this spike of inflows that we saw, 54,000 Bitcoin inflows, seems to be the institutional level. This tells me that essentially we should be concerned. If only small money, dumb money is propping up the market, that never ends well. So we should be rather concerned about that. We need to see the smart money, the big institutional money coming in, which I don't think is going to happen until the retailers are selling it to it. And the reason for this is that essentially there has to be a buyer and there has to be a seller. In order for a retailer to sell, in order for a retailer to be able to buy, so an institutional investor has to be selling, right? There's always a buyer and there's always a seller. So we have to consider that in order for the institutional players to actually get into Bitcoin, then retail investors are going to have to sell their Bitcoin to them. And that means that they're going to have to sell at a loss or further down the line once they believe that Bitcoin is going to zero because they just can't hold it any longer. And it might seem unrealistic to think that retail investors will sell, but it happens every single time. And unfortunately, you see these memes all the time about, you know, the psychology of a whale investor versus a retail investor. So we need to get comfortable, because I do think we're going to see some really interesting times ahead. I've been saying for a while that the market seemed to be a little bit too easy in this bear market. We've seen a few things occur, right? We saw Celsius, we saw Luna, we've seen FTX. And fortunately for us on the channel and our community, we were able to avoid a lot of that. And everything that's going on right now with the issues with stable coins and with Silicon Valley Bank and Silvergate Bank and some of these other platforms, again, we're avoiding it. But now I'm thinking to myself, this is really where the bear market pain is felt. This is now starting to get uncomfortable. It's getting to the point where even I and Chris are having to think more strategically about how we deploy and where we put funds in order to stay as risk adverse as possible, right? Whereas in the previous months, it was actually really easy. We didn't really have to terribly consider too much, and it wasn't really uncomfortable. Whereas right now, the heat is turning up a little bit and things are starting to get uncomfortable. This is where the bear market starts to really rattle retail investors, and also where the money starts to transfer. So this is, in my opinion, we're on the kind of the journey now to the final lows, but we'll have to kind of keep an eye on the data to see whether or not that gets confirmed. Now, here we have the daily chart for Bitcoin paired up with USDT on the daily, Binance being our data source. And you can kind of see the expectations here. We have the low area down at $10,000 to $16,000. It's a broad Z wave range. Okay, now essentially some point during this journey to the downside, there will be many moves upwards and many moves downwards. Okay, but I think it's going to be a slow kind of grind to the downside down here. Okay. Now, the problem that I have with this is that 16,000 would be no new lower low, and I don't think that's going to really fit. Okay, as much as I'd love to see a double bottom and bullish move to the upside, I don't think that's likely to occur. And the reason for this is we're not seeing retail sell their Bitcoin to the institutional investor yet. So I think we have to come down deeper. I think once we lose this low, that is where I think we're going to start seeing retail lose faith and where we're going to start seeing retail sell. Okay. And that means that I think around that kind of $13,000, $14,000 level, somewhere around here, is where we're really starting to see the whales buy. Okay. That's really what I'm thinking. So essentially, this is kind of the range. I don't want to see it go down as low as 10, but it's possible. So we'll keep an eye on that, and we'll keep an eye on the data. I said it before and I'll say it again. Until institutional money comes in, I do not see a bull market here. Okay, so we need to be really careful with what we kind of think is going to be possible. Okay, now as we kind of take a look at it from a smart money concepts point of view, you can see that we dipped down into our fair value gap that was left behind. A lot of people were calling me all sorts of different things under the sun when I was calling out some of these fair value gap areas as areas that we're going to revisit. Now, I still think this is something that we are going to visit. We can see it right here. We kind of popped down into it. We found an area of support to be found in here temporarily. Again, this would be more of a wave 4 situation that we find ourselves in at the moment, and then we're going to pull back down into this range and complete it, in my opinion. This one here will be a nice easy fill. When we go to the weekly, however, this one is not such the easy fill. This is the one that really doesn't resonate well with people. But essentially, this one here shows us that we have to come down at least to the $17,000 level to get rid of this gap that was left behind. Now, on this weekly chart, you can see that there are no other gaps left behind. If you go to Bitstamp, though, you can see all of the history, and there are some gaps left behind in the very, very early days of Bitcoin. Those never got filled. It's not a guarantee that you fill these things. There's just a high probability that you do. Okay, and the more mature the market becomes, the more likely and the higher the probability becomes that you do fill them. So when it's a really immature market where it doesn't take a lot of money to move that needle, it's not really institutional buyers that are creating the imbalances in the order books, and it was actually more just regular retail investors, and they didn't really know or understand the importance of fair value gaps. So here we can see that in an institutional player, considering Bitcoin has a huge market cap now and a reasonable amount of liquidity, we can consider that this here is actually an institutional candle that created an imbalance in the order books that creates the fair value gap, and when they cool off, price gravitates back down to it. So we know that that's an area that we're likely to fill, in my opinion. You can also see that we have a strong low, and it is very, very low at $3,700 in a week high. So chances are that we're going to pull back. I'd like to kind of think that we'd stay in the $13,000, $14,000 range, but no guarantee. We do have the structures all the way down towards 10K. Now, if we look at the support and resistance areas, we can actually see there's some interesting zones right at 6.5 through to 7.5 if that worst does come to worst. I think essentially though, 11,600 to 13,900, this little range right here, is the one that I want to kind of be the bear market low. Like I said, a WXYXZ is the maximum that we think we can see. I'm not expecting anything more other than out of the Z wave until we move up in a really significant way. We'd have to move up significantly to do a reset situation, and then potentially, if we really wanted to see a bear market drag down into those lows, we'd have to then see another WXYXZ, for example, and a really, really long, drawn-out bear market. But, you know, this time is different, and I've gone through why it's different many, many times. We are not simply doing a 4-year cycle. That BS needs to kind of be, you know, put to bed at this point. The halving has zero impact now, in my opinion, on the actual circulating supply of BTC. It's out there. There's a significant amount of supply out there. Halving will have very little effect on price movement. There's a lot of narratives out there that people think that it's a 4-year cycle, but you have to look at the data and look at the variables. What happened in the previous cycles has changed in this particular movement. We've seen things extend down deeper than the typical 1.236 that you saw in the previous bear markets. We've hit on the 1.38. We've actually dropped down significantly lower than that now. So we have to kind of consider that new variables have occurred, such as dropping down lower than the previous all-time high, the fact that the Fibonacci retracement levels are much deeper. We're not in a 3-wave structure, we're in a 5-wave WXYXZ structure. There are things that are different this time around, and you cannot ignore them. They are very important to understanding the bigger picture. Likewise, when we take a look at the on-chain data does not support the idea of a bullish market. Vastly different than where we were at the bear market lows previously. It's hard to think that you're at a bear market low if you haven't got institutional money in the space. But nonetheless, I said, that's just my thoughts and opinions. Let me know what yours are down in the comments down below. If you haven't yet joined us in Discord, check it out, linked in the description down below. There's a whole host of additional links in the description that I do think that you should check out. Everything from the Patreon services through to the YouTube memberships. We've got BitGet offering some fantastic deals for traders out there. So do join us in Discord if you're looking for more information on the various different trading competitions that we do. And, you know, there's a whole host of things. Check it out. I don't think you'll be disappointed. Until the next one, though, guys, have a fantastic day.